Good afternoon, ladies and gentlemen. This is Jesse Colombo. I'm an instructor here at Cyber Trading University, and I'm doing today's closing bell for a change. And it's called How to Profit in the Coming Bear Market, which is really a topic that I spend so much time thinking about, and you'll see why. And it's really almost consumed my life, this whole idea of bubbles and booms and busts and how to profit on the way up and on the way down. And turns out bubbles and bear markets are extremely profitable for traders, so the topic really does go hand in hand. And most investors, the typical long-term investors fear bear markets, but as active traders, we actually look forward to it because it brings volatility, and volatility means opportunity. And that's something that Fausto has always impressed upon me as well. It's something I've always believed, but I always hear his stories and war stories about trading in 2008, and he said it was a blast. So here we go. So just first, here's our risk disclaimer. Cyber Trading University and myself are not giving any investment advice. We're not recommending that you place specific trades. Everything here is for educational purposes only, as you know. Just want to discuss my background really quickly for those of you who are not aware. I'm Jesse Colombo, and I'm an independent economic analyst and researcher. And I was recognized by the London Times in 2008 for warning about the global financial crisis starting in early 2004. And this is when I was a university student, almost 10, 11 years ago, where I was studying economics and also trading on my own. And I noticed a bubble forming in the United States. And United States credit markets, housing markets, asset markets. And just for my own interest, I built a website to warn about it, and I didn't realize how big it was going to become, and it was actually in the LA Times in June 2005. I can't believe it was a decade ago. It was like yesterday. And it was in LA Times because it was one of the foremost highly trafficked websites about the housing bubble. And then to fast forward a few years, when the bubble popped, that's when I was recognized for predicting it. And then since then, I've been even more active because, unfortunately, I've been noticing new bubbles develop all around the world. So I think this current bubble cycle and the bubbles that are developing right now are even worse than what we saw 10 years ago, because that bubble was mostly focused in the United States and also some parts of peripheral Europe like Italy, Ireland, etc. This time around, it's global. So even though the U.S. bubble may not be as extreme as it was 10 years ago, if you look at the global level, it's worse. And I'm going to discuss all of that. So I built up a big social media following with about 100,000 followers where I blogged and warned about this bubble. And I've been doing it for the last few years. And then Forbes magazine took notice, and they gave me a column to write about my ideas about bubbles about a year and a half ago. And then I also discussed the trading implications, the trading ideas related to these bubbles. So they go hand in hand. And then I partnered with Cyber Trading University as an instructor to teach different trading topics. And I've been working very closely with Fausto and Rich to hone my day trading skills. And I'm going to discuss why I believe that is so important in the years ahead. So just the first concept I wanted to discuss. Most people, and you see in the financial media and economists, CNBC, TV, you see all these people are talking about the economic recovery. And it is recovering nominally, meaning on paper. You see the numbers going up, you see jobs being created, and I'm not denying any of that. But I believe that this recovery is actually fake. I believe it's driven by debt and dangerous new bubbles. And I coined a term to describe this process, and it's a well-known term right now, and it's called bubble recovery, or a bubble-driven economic recovery. And the idea behind a bubble recovery is that economic bubbles, such as stock bubbles, housing bubbles, etc., create temporary economic growth. So, for example, last decade's U.S. housing and debt bubble created artificial jobs and economic activity in related, what I call bubble sectors. And I believe the same thing is happening today in many countries and sectors as well. So last decade, a lot of the companies and sectors that were doing very well were sectors that were directly related to those bubbles and profited from those bubbles, like mortgage lending, anything having to do with consumer spending, luxury automobiles. And yet it turns out the entire recovery back then was fake. And at that time, they were considering that bubble a recovery. And that goes to this last point that I have in the slide, where the dot-com bubble popped back in the early 2000s. It was back in the late 90s. Obviously, dot-com stocks exploded. There was all this activity involving dot-coms. And then it went bust almost immediately and threw the country into a recession. So what did the Fed do so we could recover from that recession? They dropped interest rates. And they created an economic boom in the housing sector, in the consumer sector, and mortgage lending. And that helped to create all these jobs. So we got a recovery. The problem is that recovery was really another bubble. So it's a bubble. It was a bubble recovery. And I believe they're repeating that same mistake right now. That's what the Fed does. One bubble bursts, they inflate another. So a lot of the mainstream talking heads believe in this recovery. They think, no, this time it's real. And I'm one of the few pundits out there who's saying, no, it's really just a redux of the same process we saw 10 years ago. So the idea here also, another concept I want to discuss, is that debt and asset bubbles create temporary growth. So for example, if governments, if corporations and households borrow massive amounts of money and they spend that money, they can create a temporary economic boom, but it never ends well. And we've been seeing this. There's been a massive borrowing binge by governments, corporations, and households in the past 6 years since the crisis. And the other concept is that if central banks, like the Federal Reserve, cut their interest rates like they did, they cut them down to almost zero. Actually, I'm sorry, let me just address something really quickly. If it's Jerome, it's actually Jesse here, it's not Fausto. If you're having a hard time with sound, please log out and log back in. I'm just going to type that in for those of you who can't hear me. 1 second. It seems to happen in almost every webinar. Okay, there we go. So what I was saying was that when central banks like the Federal Reserve cut their interest rates, what they do is they reduce borrowing costs for corporations and households. So they can borrow very cheaply. And that leads to this, it typically leads to a borrowing binge and also temporary recovery. And also low interest rate environments like we've had for the past 6+ years helps to inflate asset bubbles from stocks to housing. And these bubbles create a false economic optimism and also what's known as a wealth effect, where when stock prices are going up, housing prices are going up, people borrow. They take out home equity lines, and then they go on vacations, and then they do home upgrades, and then they buy they buy a car. And then, and that really, it leads to this temporary boom. And that's what's known as a wealth effect. And it's really all driven by central banks that are manipulating the economy through interest rates. So I just want to show you here on this chart. This is a chart of global Libor interest rates. I'm sure you've heard of Libor interest rates. You don't really need to know the technicalities of it. Just the only thing you need to know about this chart is this is a chart of interest rates pretty much around the world. It combines the UK, the United States, Australia, Canada, Japan, or pretty much the rates throughout the Eurozone into one single interest rate chart. And Gary was saying, do we really trust the Libor? Well, the Libor scandal, when those traders were manipulating the Libor, they were basically moving it a tiny, tiny, tiny fraction for just seconds at a time. And of course, they were levering up and they were making millions on those little manipulations. But if you look at the overall rate, like what we're seeing over here on this chart, this is exactly where the central banks want it. So this really, believe it or not, is actually separate from the Libor scandal that we've heard of. But I believe this is the real Libor scandal, or the interest rate scandal, the fact that interest rates are so low right now that they've been at these record lows for a record length of time. They've been at virtually zero, depending on which country you're in, which credit rating. Rates have been so low for 6.5 years, and that creates bubbles around the world, and I'm going to show you why. So you can see this is a chart, same chart as before, and this goes back to 1986. And you can see every time there was a low period in these interest rates, global interest rates, a new bubble formed in different countries around the world, different sectors. But then when rates went up again, these bubbles popped. And you can see this was starting back in the mid-'80s. Rates were at a low. And then a bubble formed in Japan and also in the United States housing market. And then when rates went up in the late 80s, it popped Japan's bubble and also the U.S. housing bubble and led to the U.S. savings and loan crisis, which many of you older folks would, I'm sure, remember, I'm sure vividly. Some people lost their homes. I know a lot of banks went under. And really the main reason why was because rates were too low and they were increased and it popped the bubble. Then, in response, central banks cut their rates again because there was a recession in the early 90s. By cutting their rates by the early 90s, it inflated another bubble, this time in Asia and emerging markets like Mexico. So you had an economic boom in Mexico and Thailand, in Indonesia, Singapore, South Korea, because of these record low rates. And then when rates rose in the mid-'90s, it popped those bubbles. And that's why around 1997, from the mid-'90s to around 1997, there was an economic crisis in Asia, Mexico, and other emerging markets. Same thing in the late 90s, right around 1998, rates were cut because of that Asian economic crisis. And the reduction of those interest rates then helped to fuel the dot-com bubble. And then when rates started to go up around the year 2000, it popped the dot-com bubble. And then we got another recession. And then they cut rates even lower, this time to almost an all-time low. This is by the early 2000s, right around the time of the Iraq War, September 11th, early 2000s recession. That was one of the stronger economic recessions we'd seen probably since the 80s. And the Fed and other central banks were so desperate to try to boost the economy and get the economy growing again and get jobs being created again that they cut those rates so low. And guess what? They created a recovery all right. But it was based on a foundation of sand. It was not a real recovery. It was based on housing prices going up and people borrowing and spending like crazy. And then you can see by the mid-2000s when they raised interest rates again, it popped that bubble and led to 2008. So here we are. Now we have record low interest rates that are even lower than all the other times, and for much longer, by far. We're talking almost 7 years very soon. And this time, I believe the bubbles are inflating in all around the world, in Australia, Canada, emerging markets again, app and tech startups. You're hearing this all over the news. You're hearing all about Mark Zuckerberg and Facebook and all these new startups that are forming, and the way it's being presented in the media is as if these are real sustainable, this is a sustainable trend. No, I don't believe it. I don't believe it. The same visceral feeling, the gut feeling, and also my analysis, of course, that I had for the bubble 10 years ago is the same feeling I have toward everything that's booming today. And that includes housing markets in Australia and Canada. They're booming. We have a lot of Canadian students here. You could all confirm housing prices are going through the roof. I do not believe that is based on a sustainable trend. It's based on these record low borrowing costs. I'm going to get into that in a little more detail in this presentation. Another bubble that I will discuss in greater detail toward the end of this presentation is the U.S. stock market. And they're all inflating for a common reason. These are not isolated bubbles. It's not a coincidence. They're all inflating because there's this common cause or common denominator, and that's those record low interest rates. So, just want to show you some housing prices that are developing around the world right now. And this goes back to a bubble that I call the global housing bubble, where prices are ballooning around the world. And you're not even going to believe it until you see how many housing bubbles there are around the world. There's Australia, Sweden, Switzerland, Austria. And what's interesting is that the bubbles that are developing now specifically are developing in countries that were not hit very hard by the 2008 crisis, because a lot of the countries that were hit hard are pretty much bumping along, barely surviving, like, countries like Italy and Greece and Spain, even the United States and UK to some extent are still pretty much languishing, whereas some countries really escaped almost unscathed from that crisis, and those are the ones that are now bubbling up, ironically. So countries like, safe havens like Switzerland, Australia. In this case, this is Austria, but there's a bubble in Australia as well. Look at these prices in Austria. They more than doubled in a decade. I mean, just look at how almost vertical those prices went up. It's very alarming, to say the least. Brazil, another one. Canada, very scary situation, Canada. Here's actually a chart of Canada's housing bubble, and that's in red, versus the U.S. housing bubble. So you can see U.S. peaked out right around 2006, 2007, 2008. Well, believe it or not, Canadian housing prices are actually even worse. They're even a bigger bubble than the U.S. was. And exactly, Gary, that's what it is. It's because of quantitative easing, in addition to these record low interest rates, where central banks are they're printing money to try to infuse the global financial system with cash and liquidity. And yeah, it's created a recovery, all right, but it's based on those bubbles. That's why I call it a bubble recovery. Look at this, Canada. So Canada's economy is doing quite well, but why? Because they have a housing bubble. Also, Canada has a debt bubble. And this is, again, compared to the U.S. bubble. You can see this is blue is the U.S., red is Canada. This chart actually shows the household debt to income ratio. So you can see Canadian households keep on borrowing like crazy. And one of the main reasons why they're borrowing is because they're taking on massive mortgages so that they can flip houses and they can buy bigger homes than they can afford. Also, it's consumer spending. They're going out, they're buying jet skis, they're buying big screen TVs, they're buying cars, just like Americans were 10 years ago. It's really just a parallel, Same thing in Australia. It's unbelievable. Chinese housing prices, same thing. Colombia, look at this, almost vertical. It tripled in less than a decade. Finland, same thing, another safe haven. Germany too, bubble starting up there because of those record low rates in the Eurozone, and also now European QE. I would expect European and German housing prices to keep rising just because of the QE that the ECB or European Central Bank launched back a few months ago. Hong Kong has been on a tear. Hong Kong housing prices have risen by almost 2.5 times since 2009. I mean, tell me, is that sustainable? No, it's because of record low rates. Iceland, same thing. Ironically, they had a crisis back in 2008, and they're recovering right now on paper, and everyone's touting Iceland as being the comeback kid, But if you look underneath the surface, there are dangerous bubbles that are now developing in Iceland. So it's really just mind-boggling what's happening. India, same thing, like many emerging markets. Indonesia, look at this almost vertical move. U.S. housing prices are going back up, and that's because of QE and record low rates. And if you look in the long term, like let's say if you were able to erase this peak that we saw 10 years ago, and you drew a straight line from, let's say, the mid to late 90s to where we are right now, you would say that U.S. housing prices are looking a little bit lofty. They're looking a little bit high. Well, it turns out if you look in the long run, prices are very high. And that goes back to those record low rates. And I don't believe this trend is sustainable. UK, same thing, hit a new high. It's driven by London. Prices are going absolutely ballistic in London. Uruguay, Malaysia, look at that. That's a parabolic chart. It's going almost vertical right now in Malaysia. Taiwan, same thing. Thailand, Turkey, Israel, New Zealand, Norway. Norway is another country that has a housing bubble that's actually even bigger than the U.S. was. So you can see this little blue line right over here. Or it's not a little blue line, it's a faint colored blue line. But this bubble shows that it was actually even bigger than the housing bubble we saw in the U.S. 10 years ago. That's in red. It's just remarkable. All these countries that are seen as safe havens have bubbles. Norway, like Canada, has a debt bubble that is bigger than the U.S. debt bubble. So you can see the U.S. debt bubble is here in red, and this is Norway's debt bubble. So this shows how the ratio of household debt to disposable income. So Norwegians are taking on large amounts of debt, and I know anecdotally they're going on vacations around the world. They're going to Thailand. They're living the dream right now. But you look underneath the surface, and what is driving that? Oh, it's debt. There's our familiar friend, debt. Americans know it all too well, but these other countries have not been burned like we have in the United States. And I'm afraid that they're about to experience what we experienced. Philippine housing prices through the roof. Singapore, double in about 7-8 years. That's scary. South Africa, South Korea. So now I just want to show you the trend of global debt. I'm just going to go through this really quickly just to get an idea. These are charts of loans to the private sector, basically where banks are lending to corporations and households. You can see trend is up dramatically in these countries. Australia, New Zealand, Hong Kong. Look at that. That's just in the last 5 years. You have debt went from about 300,000 on this index all the way up to 800,000. I don't know the exact. I think it's in Hong Kong dollars. Don't get caught up in the actual what these numbers mean. Just realize it more than doubled in 5 years. China, same thing. Brazil, Mexico. Mexico is another economy that's touted as a wonder economy where the middle class is growing, everything's booming, but yet you look and in just less than 10 years, debt has more than tripled. So debt is a lot of times driving the growth in these countries. Philippines, same thing. Indonesia, another fast-growing economy that's a lot of it's based on debt. Taiwan, even the U.S., believe it or not. There's a lot of talk about that the U.S. is deleveraged or that we've learned our lessons since the crisis and we're paying down our debt. No, we actually have more private sector debt than we ever did. And that's what's partly allowing us to recover. Because right now, the way our economies are structured in these countries around the world, they almost need debt to constantly keep on growing. Otherwise, they fall back, they fall behind. So we're addicted to debt. It's really remarkable and scary. Singapore, same thing. It's known as the safe haven of Asia or the Switzerland of Asia. In the last 5 years, debt has more than more than doubled. South Africa debt bubble, same thing. Israel, another one. So just want to give you a quick summary of bubbles that are developing across the globe that based on my research. So U.S. stocks, U.S. bonds, some segments of the real estate and housing market are experiencing bubbles. Tech startups and IPOs, including this, especially the social media sector. There's so many new apps that are coming out. And I'm not saying that there are not legitimate ideas behind these booms or these apps, etc. They are. All bubbles have a legitimate component to them. And that's what deceives people. So that's what gets people caught up, is that, of course, they're partly legitimate. Otherwise, no one would believe them. Like, let's say the dot-com bubble. That was a legitimate economic boom at one point, and certainly the technology behind it was legitimate. And the internet's even bigger than it was back in the late 90s. But what happens is, in these type of central bank fueled bubble environments, it tends to create a mania that gets ahead of itself, and that's what I believe is happening with these tech startups and IPOs. You have so many different redundant tech apps that are coming out right now. There are so many different dating apps. I mean, it's mind-boggling how many dating apps there are out there. How many dating apps do we really need? And that's what makes me really question. I think a lot of these startup founders and investors and venture capitalists they're bubble drunk right now. They're getting so greedy because the markets are soaring and people want to spend so much money on these tech acquisitions, but I think it's really clouding their vision. I think they're making a lot of mistakes right now that'll only become apparent when this phase of the bubble pops. Another bubble, U.S. higher education, where the total outstanding student loans in the United States has more than quadrupled in just a decade. I'm talking since I was in college, which feels like yesterday. There has been a quadrupling of the amount of student loans. It's about 1.4 to 1.5 trillion dollars in student loans, where it was just a few hundred billion in student loans just a decade ago. And so many students are going for these degrees that are really frivolous, that really have very little economic value. Like they're studying baking and pastry arts. I kid you not. I'm saying this based on reality. I have nothing against baking and pastry arts, mind you. But when someone's taking on $200,000 to study something where they're coming out and they're making $9, $10 an hour, that is uneconomical. And there are so many people who are doing this, and it's not just anecdotal. You can see this in the data, and they're coming out and they're working in Walmart or they're working in retail jobs. And so that's another bubble that I believe is currently inflating. Healthcare, some aspects of the healthcare sector are getting frothy. I don't know if you've seen healthcare stocks are exploding. I'm not saying everything that goes up is an automatic bubble, but it's a very debt-driven business. U.S. healthcare relies on the U.S. government constantly taking on more debt and borrowing to support healthcare spending. And that's certainly not a sustainable trend. Subprime auto loans, just Google it. It's a well-known phenomenon in recent years where these record low interest rates are allowing people who really would not otherwise qualify for loans to get loans to borrow to buy cars. And that's helping to fuel Detroit's comeback. And now Detroit's doing quite well, but a lot of it's being financed by subprime auto loans because of these record low rates. Same thing in the shale energy sector. I mean, it's remarkable how many of these worrisome trends are happening in so many different sectors that are unrelated to each other. But that common denominator is QE, quantitative easing, and record low rates. So the shale energy sector, a lot of the activity in shale drilling in the United States was financed by energy junk bonds. It turns out drilling for shale is much more expensive and capital intensive than conventional oil drilling. So But the way companies have bypassed this is by dipping into the junk bond market. And interest rates on junk bonds are at record lows because of what the Fed has done as far as reducing interest rates. So these companies have taken on, I think it was at least hundreds of billions, if not $1 trillion or more, of junk bonds so that they can finance this drilling activity. Same thing, European government debt has actually been trading at record low interest rates because the European Central Bank has been buying up the debt of these almost bankrupt governments like Greece, Ireland, Italy, and those bond prices have been soaring because of it. Same thing in Japan. They've been running their own quantitative easing program. If you look at biotech stocks, you can just go into any stock charting service. Go to stockcharts.com, type in $BTK, and that's the biotech sector in the United States, and you can see those stocks have I think they've sextupled in the last 3-4 years. And again, there's real science behind the biotech boom. I am not denigrating that. But what happens is record low rates distorts those types of booms and causes an otherwise sustainable boom to turn into a bubble that leads to pain when it pops. And this is gonna all segue into my ideas of how it relates to day trading. Do not worry, I will circle back to that topic, but I just wanted to make sure everyone's on the same page as far as my views on these bubbles and to be aware of what's happening around the world as far as the truth. And then basically how to survive that financially. China's economy. You look up, there's tons of articles. You probably find a few of my articles actually out there about China's economic bubble. They're borrowing massive quantities, taking on mortgages, and local governments are borrowing to create infrastructure projects. Housing prices are skyrocketing, and that actually relates to the other bubble that's underneath it, which is a bubble in high-end art, wine, and spirits. There are so many Chinese millionaires and billionaires that have basically only became rich in the last few years. And a lot of that has to do with these soaring property prices and these unsustainable trends. Massive. If you look at the Chinese stock prices, they have exploded in the last 7-8 months. And there have been all these new billionaires who have been minted just because of that stock boom and all the other trends in China. And what are they doing? They're going out and they're buying Ferraris, Lamborghinis, buying houses in the US, Canada, Australia, Singapore, and they love their luxury. That's a notorious thing that the nouveau rich of China love high-end art and wine and spirits and collectibles. And if you go to any auctions in Sotheby's and other similar auction houses, they've been bidding the price of these different types of wines and collectibles to unprecedented prices. Same thing, emerging markets, countries from Turkey to Indonesia to Brazil. I showed you some of the charts. Property prices are skyrocketing. They're taking on massive amounts of debt, and they're doing very well right now. But it goes back to my idea of just look under the hood and see what is driving that. Same thing, I showed you Australia, Canada, and the Nordic countries. So it's a big list, I know, and it's been a lot of work for me to try to document these bubbles and try to write about them and warn about them. But as far as my ideas on how to survive this, I've been spending so many years trying to really agonizing of what to do. There's really not much. There aren't many ways to actually hedge yourself against this, but trading is one of those few ways. So I'll get into that, but just want to go into a little more detail about the U.S. stock bubble, why I believe U.S. stocks are experiencing a bubble, and then we'll talk about the trading aspect of it. So here's the S&P 500. This is the U.S. stock index, and you can see that it's nearly tripled since its low in 2009 during the financial crisis. And you look at that and you say, okay, you know, all right, it's a recovery. That's what happens in a recovery. But I'm going to show you why I believe so soon after that crisis, why we're already in precarious territory. It turns out the market is very overvalued. And there are a lot of different indicators you can use to analyze if a market's overvalued. But this is one of the most reliable ones over the long run. What you see here is a chart of an indicator called the Shiller PE, which is also known as the cyclically adjusted price to earnings ratio. Basically, it just measures the overall value of the U.S. stock market versus earnings. So when the stock market's value is really high relative to earnings, it means that the stock market's overvalued. And when it gets overvalued, it tends to drop shortly after. When it gets undervalued, meaning the value of the stock market is very low relative to earnings, that's the time that you want to buy and invest for the long run. So it's called being overvalued, which is bad, and undervalued, which is good. And you can see that I show you two charts. That indicator is on the top, and the S&P 500 chart is on the bottom. So if you look, I circled in red for you. That was every time the market became overvalued. And many of history's worst bear markets actually occurred when the market was overvalued. So you can see 1929 crash. I know everyone's aware of what happened in the 1929 crash. There was first the Roaring Twenties in the 1920s, and then it crashed and led to the Depression. You can see the market was clearly overvalued. And that was when this index, this indicator, rose above 20. I don't know if you can see it on here. It's a little faint red line, horizontal line. And same thing happened back in 1937. The market rose. People thought it was a recovery. And then it became overvalued again and came crashing down. Same thing happened in the late 60s right over here. Even though a lot of people are not familiar with that, the 1960s and 1950s boom, it was called, I think it was called the go-go era of the stock market. There were a lot of stocks. There was a series of stocks known as the Nifty 50, which were the 50 hottest stocks. I think one of them was Polaroid, and a lot of companies that are no longer traded anymore. And the market, after the post-war boom, became very overvalued in the late 60s. And it actually, it pretty much foreshadowed a 15-year or 15-year plus bear market that was the 1970s up until the early 80s. And you'll notice, I'm showing you the S&P 500 here. It doesn't look like the S&P 500 actually went down, but it turns out it did. Because if you factor the amount of inflation that occurred back in the 70s, as I'm sure many of you have lived firsthand, there was so much inflation in the 70s that if you adjusted this chart of the S&P 500 for inflation, this chart would look like there was a very powerful bear market in that decade. And it finally bottomed out in the early 80s. And I'll get to undervaluation shortly. Here was the dot-com bubble. This is in the year 2000. You can see this is the most overvalued ever. And of course, it led to this ongoing stagnation. It led to the early 2000 stock market crash. And it turns out, here we are, not that long after the financial crisis, and we're overvalued again. We're as overvalued as we were in some of history's worst bear markets or stagnations. So we're actually not that far away from where we were back in 2007, the last peak, and even 1929. And pretty much all the major historic tops, we're at that same level right now because the Fed would not let the market drop. They kept on inflating it over and over and over. So that's one of my concerns, is that this is a very strong bubble indicator. The flip side of this is you want to buy when the market is undervalued. So that's every time I circled in green, that means this indicator was underneath, was under around 10 or maybe around 10, 11, 12. You can see every time it was green, that was historically a very good time to buy. So the first one here was 1920, early 20s. That ended up being a phenomenal time to buy because, let's say if you bought right then, the market recovered and then there was a massive roaring 20s boom. So you would have held that for 9 years right up until the 1929 stock market crash. And then after the crash, a wonderful time to buy was pretty much in the depths of the Great Depression in the early 30s. And you can see there was a great recovery. Same thing. The market was undervalued during World War II, pretty much the entire decade of the 40s. There was a lot of fear. And that turns out that was a great time to buy because the soldiers came back, the war ended, and we had a massive post-war economic boom. And had you have held stocks from the 1940s up until about the late 60s, when it became overvalued, you would have made a phenomenal profit. I know my own grandmother actually started investing around that time, throughout that time, and it's just amazing how much you can make if you invest at the right time. But if you invest at the wrong time and you're not aware of the long-term valuation cycle, you could really lose pretty much everything you worked very hard for. And that's why I pay so much attention to this. Another phenomenal time to buy was in the early 80s. I'm sure many of you remember. At that time, this was after 15 plus years of stagnation during the 70s. And by the early 80s, nobody wanted to own stocks. Stocks were not popular. A lot of people were into gold at the time. And that's the survivalism movement was actually very big at the time. People thought really that we were going to go to war with Russia and so on, so forth. It turns out the market was really undervalued then. And anyone who bought at that point and held right into the late 90s and even up until now did very well. But unfortunately, we're overvalued right now, and that tells me one thing, that it can only go down from here. I'm not saying it's going to go down tomorrow. We may have a little bit of, a little bit left to this bubble, but as far as long-term investment, I am not a fan. So right now, I'm not investing in the stock market. I don't have a 401k. I don't have an IRA. I know it sounds a little extreme, but if you're aware of this in the history, you may understand why I'm a little more cautious. I'm also relatively young as well, though, so it's not like I'm very close to retirement. And instead of long-term investing, that's why I believe in trading right now. I think really the only option to survive financially in these times as an investor, and also career-wise, is I think trading is really the big answer. I'll discuss my views on that a little bit more shortly. But I just want to show you one more indicator that shows overvaluation and undervaluation. This is actually known as Warren Buffett's favorite indicator. So he's a multi-billionaire, as you know. So I'd listen to what he says. This indicator is called market cap, or market capitalization, to GDP. It's the ratio of the overall value of the U.S. stock market to our GDP. And it shows a very similar, it shows something very similar to this other indicator I showed you, the Shiller PE. It just shows you when the market's overvalued and undervalued. So you can see late 60s, market was overvalued. Very bad time to own stocks. And then early 80s, phenomenal time to own stocks. We've got a massive boom there. Shows you late 90s, early 2000s, bad time to own stocks. Same thing in 2007, 2008. And guess what it's telling us now? That the market is even more overvalued than it was in the year 2007, 2008. So I take that very seriously. So, and Robert, you do bring up a good point. This is not a high-frequency timing indicator. This is not something that's going to tell you to buy and sell tomorrow or next week or even to swing trade. This is just showing you the overall conditions of the market when it comes to actually trading and swing trading, I believe in trading with the trend. Do not buck the trend. Okay, the market's overvalued. That doesn't mean short automatically, and vice versa. You have to follow the primary trend. But my point is why I'm saying personally, I'm not recommending anything. I'm saying why I will not personally invest my money in the stock market right now. I will, however, invest after this coming bust. I'm gonna go all out. I'm gonna buy up every high quality stock possible, and I want to buy at the bottom, like as if it was the early 80s. That's when I want to be buying. I don't want to be buying like a sucker here in the late 60s or in 2000. I want to be buying like they did right after the Depression. And how come the government doesn't learn from its mistakes? It's mind-boggling, Mary. I really don't know. They do not listen to the people, and they have so many so-called wise economists who are really mainstream economists who are telling the same thing they did 10 years ago, that we're not in a bubble and everything is fine. Exactly, Deepak, it's corrupt. You know, and at the same time, they're ignoring people like myself. I warned about this. And I'll be 100% honest, I'm getting the cold shoulder by the mainstream media, even though I technically am in the mainstream media, I'm a part of it, but I'm getting ignored by the mainstream because they don't like my message. And they don't, it's an inconvenient truth. They don't want to listen to the truth. When it pops, they say, oh, of course we knew it was going to happen. But you have the same economists who were presiding over the last crisis, who are now basically the so-called stewards of our economy, and they're giving the same advice. So my personal hope, aside from, you know, my views and my goals as far as trading and making money, is that when these bubbles pop, I hope this creates an opportunity for a relatively young person like myself to finally rise into a higher position of power where I can start making these changes. So I don't mean to get very philosophical, but you know, there's more to life in my mind than just money. You know, money is great, but it's really a means to an end for opening doors for the bigger picture. Get off my soapbox now. Anyway, so here's another chart that's relevant to the U.S. stock bubble. This is a chart of margin debt. You can see margin debt is in red. And that's basically debt that people take on, traders take on, to trade and invest in the stock market. And many of you heard stories of the late, you heard stories back in the 1920s during that roaring 20s boom. Traders were taking on massive amounts of margin, and when the market crashed, they went belly up. So we're still using margin today, and it turns out every time margin debt peaks, that tends to actually coincide with a bubble. So you can see year 2000, margin debt peaked, and so did stock prices. You can see there in blue, that's the S&P 500. Same thing in 2007. And in this case, the bubble is even bigger if you just look at margin debt. Margin debt is far higher than it was back in 2000, 2007. So that is really scary, especially the fact that this most recent surge of margin debt only occurred in the last few months. It's only really just as of 2015 that this most recent phase of the surge happened. And that's really what's partly propping up stock prices, is that people are borrowing to buy, and that makes the market go up. So what is the role of the government in the economy? You know what? I'm going to be doing many more webinars and many more workshops. You know, this is such a complicated topic, and there's so many different facets to it. I'm going to have to definitely save it for future webinars, and I'll definitely address that. But it's one thing at a time, I guess. You know, we have to view it as for now. But thanks for the ideas. I'll definitely discuss this in the future. So anyway, just want to discuss the key takeaways of this presentation. Is that stocks are very overvalued right now, and I believe they're experiencing an unsustainable bubble, which I believe makes them a poor investment right now. I'm not This is not investment advice. I'm not telling you what to do with your money. I'm telling you what I personally believe based on facts. Right now, because the markets have been going up so much, there are many traders who think they're geniuses right now. And it's only going to get worse as the markets go up. They think they're geniuses. I'm talking about the kind of traders who are really not traders. They're just buy, hold, and pray type of traders. And yes, everyone, this is all recorded. Don't worry, I'm sending it out when it's finished. These are traders who think they're geniuses because they're buying and holding, and the market's going up, and they say, "I'm a genius. I'm good at this. I've got a knack for this." But you have to remember the old traders adage. There are two of them that I like to use in this example. Don't mistake a bull market for brains. And two, a rising tide lifts all boats. And that's what's happening with so many of these investors and traders right now, is that they're conditioned after 6+ years of the bull market to think the market really only goes up. And that they think they're almost invincible. The problem is, when the eventual downturn comes, I believe they're going to get caught off guard when it pops, and they're going to lose most of their profits. And some of them will lose a lot of their initial investment because they tend to lever up at the precise worst time, which is pretty much near the top. That's just the way it works, is that the dumb money tends to pile in right at the top. I mean, they don't get in at the bottom. How to survive the coming bear market. I'm probably going to be doing a lot more webinars on the different facets of this, as I said. But one of the reasons why I came to Cyber Trading University is because I wanted to really hone my skills as a day trader. I've been involved in trading for a long time, but the idea of very, very skilled day trading really appealed to me, because I started thinking and realizing that it is ideal, because not only are you able to profit from the market going up as it's inflating, but you can do it on the way down. And I know you can do the same thing as a swing trader, but there's a lot of appeal for being able to trade and primarily focus on intraday. And here's one of the main reasons why. Because if you're an intraday only trader, you're not taking on any overnight risk. And if any of you remember the financial crisis and what was going on in the markets, there were massive overnight gaps that, let's say you placed a swing trade or you held a stock overnight, either you're shorting or going long, and the next day you wake up and some sort of there was a central bank intervention or a very powerful person made a statement and caused the market to move very dramatically, and now when it opens up, it gaps against you and you have no way of cutting your losses. So, and that really goes to what Fausto says, and I really do agree with him, where he says no overnights. I'm not saying you should never trade overnight. I'm just saying in a financial crisis, when things get really volatile, that's when intraday traders shine. And that's why I myself have been honing my skills with this, because I want to be ready not only for trading the market on the way up, but also on the way down. And I was saying here, you can profit from the inflation of the bubble as well as the inevitable crash. And we have many people here who are in the CyberGroup trading room who trade every day, who may not realize it, but a lot of the stocks that we trade are actually related to the bubbles, as funny as it sounds. Like a lot of the stocks that have been high performers over the long run, let's say maybe the last couple years, a lot of these smaller cap stocks, you may not even know it, but if you do further research into the fundamentals, very often they're directly related to these bubble sectors. And same thing on the way down. Like very often we'll see a stock, like let's say, I think the other day we traded ESI, which was ITT Tech. It was an online education company. And that stock crashed, and we were shorting it on intraday. And many people in CyberGroup may not know the backstory behind it, but it turns out it has to do with the education bubble. And that now that company was going under because there's a lot of turmoil in the for-profit education sector. And students have been taking on massive amounts of student loans, and now they're finding they can't get jobs. And now there's this huge backlash against those kind of stocks. Another one is APOL, Apollo Group. They own University of Phoenix, a lot of these companies are stocks that we've traded that are directly related to the bubble. Same thing, we traded PBR or Petro Brasileiro in the CyberGroup room. And we've traded Seadrill, SDRL is another one. There's so many of them that we traded this past fall and the past year. And it turns out those are related to the oil industry. And oil, there was a bubble that formed in oil prices that I warned about a year ago. And when that bubble popped, it caused the entire oil sector and oil stocks to crash. And then all of a sudden we start to see them in the CyberGroup in the morning and afternoon list, and we start trading them. So my point is that the inflation of these bubbles, the continued inflation of the stock bubble, and then its eventual crash, is going to create phenomenal trading opportunities. And this is something that excites me, because I remember Fausto and I have this discussion very often where he tells me about how he traded during the 2008 crash. And he was shorting bank stocks like Lehman Brothers and Bear Stearns all the way down. He was doing it on intraday, but every day it would show up in his watch list. And he would just short for days and days and weeks and months on end. And he when I told him, I said, are you worried about what's going on around the world with bubbles? He said, I'm not worried at all. He said, bring it on. Not that he wants anything bad to happen, but he said, bring it on. As a trader, I'm going to make a fortune from this. And I know Rich Lepis has pretty much said the same thing. So that really does inspire me, is that it's one of the few ways to actually hedge yourself against the coming popping of the bubbles, is that if you can become such a skilled and savvy day trader, you can stand to make literally millions of dollars. I'm not exaggerating because I don't do that, but you can make millions of dollars by trading the popping bubble sectors. So that's what I'm personally positioning myself for. That's one of the reasons why I work so closely with Cyber Trading University, because I myself, I'm very interested in this for strategic reasons. So as I was saying, yeah, there's potentially millions of dollars to be made. It's really not an exaggeration, because we do have people in the CyberGroup who are making millions of dollars. It sounds preposterous if you were not aware of how it works, but through compounding, they just grow their accounts so dramatically. It's really remarkable. But you're going to need to be very skilled. This is not going to be an ordinary trading time. It's going to require a higher skill level, but there's going to be much higher potential profits. So to take advantage of that kind of volatility. So I mean, we're going to see all sorts of different bubble sectors when they start to unravel. We're probably going to be trading a lot of tech stocks. When a lot of tech stocks, the air comes out of those inflated sectors, we're probably going to be trading them all the way down. It's going to be phenomenal. I mean, so that's really what I'm looking forward to. So I'm going to be doing a lot more webinars like this on different topics related to this. But I just wanted to give you an idea of how you can become a better trader and really hone your skills, because this is something we all need to really focus on if we want to be able to take advantage of this opportunity. For those of you who are not CyberGroup members, I'm going to give you a link right here. We have this 1 week, $29 CyberGroup trial, where you'll have the opportunity to come in and see exactly what we do, Fausto, Rich, and myself. Where you'll have a chance risk-free. If you don't like it, you get your money back. You're not going to want to, because you're going to enjoy what you see as far as the kind of money that these traders are making all day long from these stocks that are crashing and soaring. So come on in, you'll have a chance to see exactly how these traders trade. $29, I just gave you the link. CyberGroup Pro Trial. And then also another way too is you can sign up for one-on-one coaching. I do one-on-one coaching just like Rich does here at Cyber Trading University, and it's been immensely popular. We're backed out for a very long time on coaching, where we have just so much demand for that type of one-on-one coaching. So if that's something you're interested in doing and discussing how to prepare for the coming crises and also how to boost your trading savvy, just email me, jesse@ctutrading.com. And hope to see you in the CyberGroup. Definitely looking forward to that. So now I'm going to answer. I'm just going to go through all the questions. So many over here. Let me look through. Wayne, that's a good point. Day traders have no risk overnight other than the solvency of your broker and the currency itself. Well, that's why my goal actually is, I think it's a good idea personally, if you can make significant day trading profits, maybe take some of that out and then use that to buy other assets. Like in my case, I want to buy physical gold. I want to buy rural property with those profits so that I'm diversified. Deepak was asking, do you trade inverse ETFs? Yeah, I mean, there's no reason why not to. I wouldn't want to hold inverse stock ETFs in the longer run, just because they tend to, if you look at their stock chart, they tend to degrade over time, meaning they're biased against anyone who's trading them. If you're holding them long, what happens is it's very complicated, but a lot of these companies that create these ETFs, they have to create these synthetic positions using futures and options and other exotic derivatives, and that leads to a lot of costs, transaction costs, and they pass that on to the investors who invest in those ETFs, and it tends to cause the stock or those ETFs to drop over the long run. So I'm not really a fan of, let's say, holding those stocks over the longer run, but as far as day trading them, no problem whatsoever. And exactly, Lita, yeah, Corinthian Colleges, COCO, what used to be Coco, that stock went down to 6 cents, and it's now on the pink sheets. Oh wow, 0.006. It's remarkable. I remember that stock in 2002. That was one of the first stocks I started researching when I first started studying the Investors Business Daily CAN-SLIM method, and that stock was on the way up, and it was a phenomenal growth stock. I mean, it really, I think it was at least a 10-bagger. I think it increased by more than a factor of 10. And why? Because the higher education bubble, or at least that online education, for-profit education bubble, was actually, that was when it was inflating. And people were making a fortune on the way up. And then in recent years, that bubble's now popping. And what do you know? We traded it on the way down. And we're going to be seeing a lot more like that. Like, do not be surprised if we see a lot of these recent tech IPOs that are so many people are excited about. Those companies are very overvalued. I would not be surprised at some point when investors come to their senses that those are going to start showing up in our daily morning and afternoon CyberGroup stock lists, and we're going to be trading them on the way down. So there's going to be a lot more companies like that. I mean, so many different companies. It's remarkable. So, all right, folks, I know there's a lot of information, and definitely hope to expound on this topic a little bit more, but definitely if you've never really tried CyberGroup, you really just have to just get in there. $29, it's money well spent. You know, it's a phenomenal education. You can buy a book for the price of $29, but you're not going to get the kind of education that you're going to get from seeing real traders actively approaching the market. So I think you will be pleasantly surprised. And as I said, if you want to do coaching, just shoot me an email at Jesse@CTU Trading. So thank you so much, folks, and have a wonderful night. Actually, also want to say another thing, too. For CyberGroup members, on Friday, I'm doing another webinar. It's actually another workshop. It's my Candlesticks Part 2. It's going to be advanced candlestick analysis. So another reason for you to sign up for CyberGroup. All right, everyone. Have a wonderful night. Take care.